I saw this post in one of the first home buyer groups and thought it would be the perfect example to go through how I would approach it if this person called me. So save this video if you'd rather learn about the process without actually having to talk to me on the phone. So obviously they've got good income and 140K in savings for the deposit, which is awesome. This is like the perfect client. If this person was to get a house, obviously they'd be buying with less than 20% deposit because their income is strong enough to probably go to 1 million to 1.1 worth of lending, and then you add your deposit on top of that. So they could be buying for like $1.25 million. But I may not advise that because it depends on their actual expenses. And this is how I'd kind of break it down. If you bought for, let's just say 1.15, you got $1 million mortgage. That mortgage would cost you about $1,260 per week. You can see here, which is about $5,500 per month, which sounds like a lot, but you need to compare it to the actual income. And if you take off tax of that 200K in their pocket, they'd probably be getting about $12,500 per month. So $12,500 is what they're getting, and their mortgage will cost around $5,500 per month. So that leaves them quite a lot of money. It's not quite half of their income going towards their accommodation. There is a rule that, it's nice to aim for like 30 or 40% of your income going towards accommodation, but you also need to be realistic for what $1 million is going to buy you in this country, depending on where you live. And then the other part of the equation is obviously that's on a higher interest rate because they have less than 20% deposit. So do they keep saving until they have a 20% deposit, or just buy now? And I think the answer to that question really depends on what you think is going to happen to the property market, because if it takes you another year to get to 20% deposit, what could happen to house prices in that time frame? If you knew for sure that they were going to go down or stay the same, then of course, wait as long as you want, get 20% deposit and then buy. But we don't know that for sure, and most likely they're going to slowly creep up. And a 5% increase on $1 million is $50,000. So $1 million house today might cost $50,000 more in a year's time, and the goalposts kind of keep moving. And if you'd rather have the cheap interest rate in a year's time, that's all good, cool, keep doing that. But remember that the low equity margin is only added until you have 20% equity. So if house prices were to go up, your equity increases. So you've locked in a smaller mortgage amount, yes, a temporary higher interest rate, but as soon as you get the equity, you get the low interest rate, and you still have a lower purchase price and a better house, assuming house prices were to go up. And that's the problem, is we don't know exactly what's going to happen. And a lot of people, I just say, look, if you want to buy a house and it's your lifelong dream and you are able to do that today, and there's a house that you've seen that you like and you're not just buying it for the sake of buying it, then buy it. Like in a year's time, things might be different. You might have an accidental child, you might lose a job, you might, things might be in a situation where you might not be able to get a mortgage. You might not realize that being self-employed, you need 2 years worth of financials, and then you're like, oh shit, I can't get a mortgage for another 2 years. So yeah, bit of a longer video. I hope it helped you understand a bit more about my thought process when people have situations like this. And if you do actually want to talk to me, there's a link in my bio.